This is Alan Bush with ADMIS. In the stock index futures, we did see some overnight pressure developing, although it was very limited selling. This on a second look at the deficit accord. Apparently it does not do enough as far as severely reducing the deficit. Some traders are beginning to question the long-term impact of this. Also, we will have the debt ceiling revisited again. That debate likely to take place in mid-February. So that one negative likely to undermine stock index futures, even though we did have quite a bit of euphoria after the deal was announced as far as cutting the budget deficit. Earnings season starts next week. There's not much talk about this now, with many traders focusing on what's happening with the budget situation. But earnings are likely to be a bit on the weak side, at least as far as the rate of growth. So I think that negative could undermine futures over the next few days into the earnings season, once again to be reported next week. Over in the foreign currencies, seeing the euro currency under some pressure. This after loans in the Eurozone falling again. So this is probably the dominant influence taking the euro lower. Also, we had some pressure in the pound. This after UK home prices falling slightly, a little bit weaker than what many analysts had anticipated. The yen higher after we did see 20-month lows in the yen being registered yesterday. We're inclined to believe that any gains in the yen will probably not follow through to the upside. We do have prospects of substantially easier credit coming from the Bank of Japan. This will probably continue to undermine the yen in the longer term. So look for lower prices for the yen with what we're seeing probably later today, and then pressure developing, I think, over the next several weeks. At least in the credit markets, seeing futures basically steady, some pressure developing with the ADP employment report coming in higher than expected. This somewhat offset by jobless claims also coming in higher than expected. So those are somewhat negating influences. Longer term, we feel that the Treasury markets will hold up, even though we are now at a bottom of the 8-month trading range. Longer term, expect higher prices for the Treasury futures market as the global economy continues to slow. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.